So in this video, we're going to be talking about the types of Forex orders. There are various types of Forex orders, and I'm going to be explaining just four for you. These are the main ones that you need to know, the only ones I actually need to know, right? So I'm going to be explaining this. The first one is the market order, the limit order, stop orders, and take profit and stop loss. So what are market orders? It's very simple. Market orders are simply entering the market right now or at the current price. What that means is if the market is moving and you want to enter at the market order, that means you're entering at the current price of the market. Whatever the price is at that specific moment, at that point in time, is where you're going to be entering. That's where your entry is going to be. All right, so this is very different from the other orders I'm going to be explaining. Now, the second type of order is the limit orders. Now, the limit orders is quite different from the market order in the sense that you're entering the market at a desired price, usually a pullback. So the market order is you entering at the current price of the market, while the limit order is basically you entering at specific price points in the market. Now, what that means is, for example, if the market is going up, right, and then you want to enter this market, and you simply put a limit order down here like this, and then when the market goes back down to this price point, right, when the market goes to this price point and touches it, the market will automatically put you in a buy position, and then if it continues up, you make money. If it goes down, you make loss, right? So that's basically how the limit orders work. You put your order at a specific price point, the market goes there, touches it, and then reverses, right, or continues up. It basically puts you inside the trade. While market orders, if the market is going up like this and then you buy, you're basically buying up here like this, right? So you're basically entering at the current price at that moment. Now, stop orders are entering the market only if the market moves in your favor, usually a breakout. Now, what this means is it's quite similar to the limit orders, but it's different in a way. What this means is if the market is going in a specific direction, let's say you want the market to go down. Yes, so you want the market to go down and the market is actually going down. So you basically put your order here and then the market goes there. And if the market goes there and touches it, it automatically puts you in a sell, right? Because you're expecting the market to go down. So you're putting a sell order down there. It's called sell stop. So there are basically two types of stop orders. There's the buy stop and then there's the sell stop. Right. So if you're expecting the market to go down, you put your sell order down here. And if the market goes down and touches it, it automatically puts you in a sell, right? And it's usually a breakout. What that means is if you have a support here, if you have a zone here that price hasn't broken, right, and you expect the market to break this place and continue down, or when the market breaks it, you want it to continue down, you basically put your sell stop here, and then when the market breaks that point, it activates your sell stop and puts you in a sell position. And if the market continues down, you make money. Same thing goes for the buy order, right? For the buy stops, it's the same analogy, just to the upside. Now let's go to the third one, which is stop loss orders. Now stop loss orders are not like buy limits or sell. They're not like limits or stop orders or even market entry. It's basically you exiting the market at a specific price point. So exit the market at a desired price if it goes against you. All right. So for example, if you bought a currency pair, let's say you bought a currency pair, the market was going up, let's say you bought here, what you basically do is your stop loss would be above this price point. So while your stop loss is there, let's say this is your stop loss, the stop loss is there in order if, as you bought here, the market continues to go up, right? If it continues to go up, you set a stop loss there so that if the market goes to that price point, it takes you out. It's a form of risk management where because if you don't put your stop loss and the market passes your entry point and continues going up, the higher it goes, the more money you lose, right? So in order to stop your loss, that's why it's called a stop loss. So you put your stop loss at a specific price point. So when the market reaches that price point, it's going to automatically remove you from the market so that to limit your loss, right? So that's basically what stop loss is. Now the fourth type is take profit. It's the opposite of the stop loss. So the stop loss stops your loss at a specific price point, while the take profit takes your profit at a specific price point. Now, it's the exit of the market at the desired price if the market goes in your favor, also known as the target price. So if you use the same analogy but in reverse, it basically means this: if the market is going up and you bought, or wait, let me use a different place because of the screen space. So if the market is going up and you bought, let's say you bought at market price, right? Your stop loss would be, let's say your stop loss is down here. Your take profit might be up here. So what this means is, if the market goes to that point, it's going to take you out of the market in profits, right? So if the market continues going up like this and hit touch this price point, it's going to close your profit at whatever dollar amount this price point is. It's going to close you automatically, because why you need to set that is because if you don't set it, right? So let's say this is price, and then let's say you have your stop loss down here. If you don't set a take profit, the market might just do something like this. So the market might just do something like this and then come back down and then take you out on your stop loss, when you would have had your take profit here and you would have taken the amount of money that you wanted to take, right? So the stop loss and the take profit is good for it's good so that you can have a system, in place, so that you can set everything, so that you can instead of making emotional decisions and just trading around. Because if you don't set those things, it's kind of like gambling, basically. All right, so that's basically the types of orders that we have in the forex markets. We have the market, the limit, the stop, take profit, and stop loss. That's basically how it is. So let's get into the next video.